A credit repair expert can provide tremendous value to home buyers, especially first-time buyers that may think their credit challenges are preventing them from buying a home. Did you know a small improvement in your credit score can potentially save you thousands of dollars over the life of a mortgage?
Today, we're joined by a credit repair expert. He will explain what really impacts your credit, how to avoid costly mistakes, and what steps you can take towards putting yourself in a stronger position when buying a home. If you ever wondered how credit works, this is an episode you won't want to miss. I'm Isabel Machrone.
And I'm Rosa Ortiz.
We're real estate professionals in Southern California.
And each week we break down what sellers and buyers really need to know right now.
This is Let's Talk SoCal Real Estate.
Welcome, David, to our podcast. We're happy to have you here. And can you tell us a little bit about your background and how long you've been doing credit repair?
Absolutely. And thank you guys for having me. My name is David Lopez. I'm the CEO and I'm the founder for CredStart. We've been around now going on to 14 years. Actually, I've been doing this since I was a kid. My father used to own one of the largest credit repair companies in the country. And this is how I earned my allowance. I mean, from the moment I could work, back then we were using letters. The entire household would sit there and watch TV and fold letters to be able to be mailed out. I transitioned into data entry, eventually into sales, and worked myself into management. My father ended up passing away. The company, due to all the investors and all the hands in the pot, it got dismantled, and I turned around and opened my own company in 2013.
Thank you for sharing that story. That's really cool that, you followed your dad's footsteps.
Oh, absolutely. Happy to share.
That's awesome. Most people don't know that credit repair is an option. What is the misconception that people have about credit repair?
I think you hit it on the nose, which is the fact that it's an option. At the end of the day, the majority of these individuals that end up becoming our clients, they did run into an illness. They were fired from their job. They somehow fell under pressure. And then, to be frank with you, some people are just irresponsible, right? There really is no class or school. They don't teach it in college. No one really actually guides you into how to start your credit. So it's generational, right? It's either your parents tell you or you just learn through hard knocks. So when people go ahead and compromise their credit, I think it's the biggest misconception is understanding that someone in fact can help you and that there is a way out, or understanding the laws. So typically that's where we come in, is to help them understand or explain. I'd say the biggest analogy that I could use here is, it doesn't matter if you're driving 100 miles an hour, you run 3 red lights. If you get pulled over, ultimately the burden of proof falls on the court and the police officer to determine if you are or not guilty. It doesn't matter if you actually did it. It's if they're able to provide sufficient data to be able to pin it to you. And that's here. At the end of the day, you're a civilian. These are multi-billion-dollar companies. The burden of proof falls on them to be able to say, yes, it is them, and this is the data, and this is what I have. Or it's easier to take it as a write-off and let people move forward. The liability is too heavy for the banks.
Okay. A lot of the credit repair that I deal with, or most of it, is helping my home buyers when they want to become homeowners. What is considered good credit in your point of view, and how does it directly affect the interest rate the buyer is getting? So,
regarding the first question, which is what is considered good credit, it sounds silly, but it is all relative. So an individual that has a 500 credit score and they're trying to qualify for, say, an FHA loan, it does cap out, right? They don't need a 740 or 760. The bar is set lower, and ultimately to them, achieving, say, a 680 plus, they'll cap out at what the best rate possible is. And that's considered good credit to them. Then you take a look at somebody that's trying to buy a multi-million-dollar home, where the standards are much higher. If I had to give you a very transparent response, there is, if I break it down as, say, school grades, I'd say an A, right, a 95 or 98% falls right within like a 720 parameter. There comes a point, I get clients that come in with a 600 score, and everybody says they want an 800 because that's what they see on the internet or on TikTok or whatever it may be. But the reality is 800 is just ego. There comes a point where, say, if lender comes to me and they go, hey, I need a 740 plus, I let them know that at that point, I don't have control over 740 plus, because the reality of it is it's in theory perfect. So there comes a point where I lose control and there's nothing that I can do. There's no negative items. There's no inquiries, where you just have to pay your bills on time.
Yeah, thank you for clearing that up, that it's relative to what their goal is, their ultimate goal is, or what type of loan program they're trying to get. I do get a lot of people that think they have to have that above 700 when, like you said, a 680 may be good enough.
What are the habits that should be avoided likely immediately, and the most common mistakes that people make in damaging their credit score?
I believe a lot of people think that more is more. So you'll see individuals apply for an abundance of credit to be able to kind of they think a lot of credit cards is a good thing. So from an angle of them being productive, it's very much not the case. Mm-hmm. At the end of the day, there is a history average and a limit average. So when you end up, getting a 300 limit card on one end and then turn around and you have you finally got a high limit card, everything averages out when it comes to credit. So that's extremely relevant. And then I would say the biggest factor is just paying things on time. Paying things on time and ratios definitely factor in. And I would say as long as payments are being paid on time, as long as there's no impulsive running of credit, that everything works out as long as they don't get hit with any new collections.
How about for prospective buyers that are looking to purchase a home? What are the steps they should take if they want to buy a home within 6 to 12 months?
I would say stay away from buying a car, because I feel like that's what I've been running into the most lately is impulsive car shopping. I always have to coach the clients that if their bottom line goal is to purchase a home, that the home has to come first and the car needs to go after. And typically everyone figures the car is the smaller item and the home is the bigger item, more accessible. So they end up proceeding, getting the car. And then that's what ends up actually tapping them out from being able to qualify for the home, where all of a sudden their ability, their buying power significantly drops because they decided to get a vehicle for a high ticket amount. So that needs to be handled backwards. It's making sure that, the borrowers are coached that first get your home. And after that, if you want to go, get your Macy's tote bag and you want to get your vehicle and you want to do anything additional, gun it, go for it. But definitely the house goes first. That's the priority.
I love that. Do you need to wait like a year?
I would say the recovery time is typically about 6 months to a year. When you get a brand new vehicle, also, you see individuals just running their credit like crazy. It's very typical. The term is called shotgunning the credit. You go to the dealer, they go ahead and shop you around at the banks, and then all of a sudden you end up with a dozen inquiries. So that shocks the credit alone. You're not even taking into consideration the new debt amount that's going to hit the credit. As I was mentioning, a lot of things on credit are about averages. So now you have a brand new liability, say of $30,000. You're starting from scratch. So if your credit history, say, was 5 years, now you're adding something that's day one. It's going to get average. You're taking on a new liability, a new payment. So the credit really does take a little bit of a shock when you talk about that heavy of debt. Really, to be able to recover, it's typically 6 months to a year. That is a good average.
Okay. And if they need to buy a car because they just don't have any other form of transportation, they just have to realize that their purchase power just came down, and maybe they still can buy the house, but not at the same, they're not approved for the same amount.
That's very much correct. I've seen it happen time and time again.
In order to set realistic expectations, how long does it typically take to see results during a credit repair program?
And for them to be able to start seeing the process kind of take place and start seeing the credit score grow, I think it's something that they can see as early as like a week. As soon as we start engaging already with the credit bureaus, just start seeing that stimulation. In fact, right now our turnaround times have been anywhere between 14 to, I'd say, 60 business days is on average. You have to keep in mind, yes, we are a credit repair company, and if someone is seeking perfection or just wants to fix their credit because one day eventually they want to do something, that could drag out. That could drag out 6 months to a year. But be a borrower that's looking to do something immediate, right? That they're trying to buy a house within the next 90 days, within the next 3 months, 2 months, whatever it may be, that's goal oriented. So we don't need perfection. What we need is to achieve a goal. So
On the consumer's urgency, correct?
yes, absolutely. The consumer's urgency, the circumstance, and also, if a lender runs credit, sends me a copy. If you tell me what the goal is, I'm an analogies person, right? I think that's what gets
like that.
me just data best. Somebody that wants to say lose weight, it's easier to tell me I want to lose 14 pounds and know where they are in the scale as opposed to someone that says I want to be thin, right? Be thin is so relative, and ultimately that might be a goal that could take, say, a year or two, because it's until you figure you're thin, right? You figure you have a 700 or 720, or you're gunning for an 800. But if you tell me you need a 660, I know like this is the goal, and it's a lot easier to achieve that as opposed to I want to have good credit. And that's the difference between the two on something that can be very long-term or something that can be knocked out within 2 months. It's goal orientation.
So in order for us to understand what issues should be addressed first, what negative items on a credit report have the biggest impact on a person's credit score?
The biggest impact that you see beyond any collection, beyond any charge-off, beyond anything, are late payments. That is the biggest impact I've seen destroy a credit report and just destroy a score. Typically, what you end up saying is, if you have a brand new collection hits your credit, you have a new negative. When you're late on something for the first time, you are taking away from your positive section, which at that point will dock your score automatically, and you're adding to the negative. So not only are you losing a positive and you're taking a hit there, you're gaining a negative and you're taking a hit there. Every negative item can hurt you anywhere between, say, 15 to 80 points plus. So when you're factoring in the loss from the bad, and also the fact that you lost a prime account that was giving you history, relationship, establishment, that double whammy, I've seen credit scores just get massacred. So that's the one. It's late payments.
People are surprised when you pay off credit card debt and then it actually hurts their credit score. I've experienced this with my husband. It's like, I just paid this off and my credit score dropped. And he's working on building the credit score. When you're paying off a credit card, it can drop it. But when you're paying off a different debt, does that increase? What's the balance?
It goes back to that frustrating concept of there's no one to teach you, right? Everybody's just doing whatever they try to do what they think is right because we're using common sense. I paid this, so this should happen.
And this is exactly why we have you on here.
It is, always happy to share knowledge because I think it's so important. And, I'd say you pay off your vehicle. The same way that when you get a car, it shocks your credit. People assume I just paid off my car. Like what an accomplishment. I just paid off what I've been working on for 5 years. And the thing is, that's an installment loan. It started high and it's working its way down. So when a vehicle is paid off, what ends up happening is it's closed out. You lose all of that history. So paying off a vehicle actually ends up being something that docks a score and can lead people to be very frustrated because they think it's such an accomplishment.
Exactly. That is the goal. That is like, I have 4 more years on my car, 3 more years, to pay it off. And it actually works the opposite when it comes to credit score.
Yeah. Super, super bummer. You get the pink slip and your credit score drops. Not fun. But on the revolving credit cards, and actually, I'm sure a lot of people say on TikTok and Instagram or blogs might disagree with me, so it's very unpopular feedback. But, we cycle high volume. We're not talking about hundreds. We're talking about tens of thousands of files now that we've worked on throughout the course of this, through my career. Mm-hmm. Paying down credit cards will always affect the credit score positively. And maybe because there's different algorithms, you might see otherwise on Credit Karma or IQ or through your, Capital One app or whatever it may be, you might see weird triggers because their algorithms pick up different things. But if your priority is buying a house, I'd say 10 out of 10, if they pay off, and it's difficult giving instructions to borrowers. They're already stressed out. So being like, hey, pay things down to 10%. They're over here doing numbers or using a calculator. Mm-hmm. I thought so much easier to direct someone, just pay it off. Let's wrap it up, pay it off, And then at that point, let's see your credit score be impacted, and you'll genuinely see it just shoot up. And that is the instruction that I give to all the clients, is just, if you can pay it off, please by all means pay it off, as opposed to doing percentages and giving them one more homework assignment when it really isn't necessary. You'll always see the credit score rise when the balance is paid off on the credit card. You always will see it. Could there be a variance if, say, they left an additional $500 on a card? Possibly. But because we're running it through our algorithm that matches the same one as the mortgage calculator, we guide them through that to give them that direction. And we'll always just say, if you can pay it off, just pay it off. Let's not deal with the headache and the percentages.
But the trick is not closing it out, correct?
Yeah, absolutely. Yeah, okay. Because it goes back to the history and the average. By closing it out, that's another one, is we'll see people where they're so frustrated with their 30% APR credit card, and they're paying it and paying it and paying it. Finally, they pay it off. Finally, I'm done. And they'll close down the credit card because of all the frustration that led to. And then their credit score dumps.
Drops.
Yeah, they're like, I've been dealing with this journey forever, paying these crazy interest rates, and I closed it out, and now I lost my credit score. So.
And that drop is temporarily, or how long does that last?
You know what? If they have other credit cards to balance them out, it is temporary. But if you give me someone where that is their only credit card, that is not temporary. That will sit there, and it's like, it is possible to not have a score. Like, beyond good credit and bad credit, there is no credit, which is zero, where they'll run your credit score and it says NA, not applicable. You're like an 18-year-old on paper. And that's not just for individuals that are 18 years old. It can be the individual that's never wanted to use their credit. They don't trust the system. Mm-hmm. Individuals that just got their social security number, immigrants that got here and went through the process, got their social issued, and they make their six figures, their whatever industry they may be, and ultimately their credit score is zero. So say that person that you're referring to, if they had a credit card, they've been paying it on time, say they have a 670, 680 because the balance was high, they pay it off and close it, it'll go back to zero. They'll have NA again. It'll deactivate their credit.
Can they possibly just open another one with a lower interest rate, only because maybe they just want to get rid of that 38% interest rate for that one they closed out?
So if they were to do that, they would start their history all over again, similar to a 18-year-old. So it will take them 6 months to a year to reestablish that relationship and get the credit score back up. So the key here, do not close the credit card. Once you pay it off, leave it, suit it aside, so you get to put that trophy aside, so you keep your history, and go apply for another credit card that actually has a zero APR or low interest.
Do you know what happens if you just keep it at a zero?
It probably, it may. More like
expires, I think, yeah.
Yeah, it just, due to, especially right now in the economy shift, you wouldn't see that as much before, but right now, because of the economy shift, what we've been seeing more and more is there's no need for that exposure. You're not even using the card. So then giving you an 8,000 limit, if God forbid you lost your job tomorrow, you're going to prioritize feeding your family over having good credit. So it does, the banks have been seeing reel it in a little bit, dropping limits, closing out credit cards that are inactive for 6 years. So I'd say as long as you're throwing on $100 balance every 6 months, that's enough to keep the credit card stimulated and have the banks keep it open.
Excellent. I like that.
David, what are some simple things people can implement now or this month to improve their credit?
There's all the obvious ones, like make your payments on time, keep balances low. If you want a good hack that I think individuals could have immediate gratification over, and not everybody can benefit from it, but I'd say the average consumer can, is, authorized users are a really, really cool hack to be able to cut in line and be able to maximize your credit sooner. The thing about authorized users is the concept there is, your brother, sister, partner has good credit. They have a limit of, 5,000. They've had it for the last 7 years. At that point, they're capable of calling the bank and adding you on as an authorized user. At that point, that trade line will show up on your credit along with the history, along with the limit. And at that point, it gives you credibility right away. If you give me an 18-year-old that has nothing on the credit, zero, and their parent, who has good established history credit card, adds them on as an authorized user, they'll be 700 plus within, in say 60 days.
Yeah, I did that for my daughters just to, when they were teenagers and started their credit, I added them as an authorized user to begin their credit.
And I'm sure they very much benefited from it. But just the same, unfortunately, not everybody has a resource similar to what you provided for your daughters. So it is something where...
Good hack.
Yeah, it's a hack for someone that has the ability or the relationship for someone
Right,
for them.
exactly.
Okay, so now what are the red flags? How can someone protect themselves from scammers or people that scam people, vulnerable people, in repairing their credit?
Sure. So that one is a little bit of a tough one because at the end of the day, there's people that are good and bad in every profession, right?
Yeah.
There's the realtor that cares, and then there's the realtor that ends up just doing it for the buck and might stick them in some creepy house. Or same with the loan officer, ones that charge these crazy points, or the ones that genuinely. So that is every single profession. The concept of word of mouth, which is being the most old school way of advertising ourselves and building relationships beyond social media, beyond anything internet related. I'll always say lean into that, but not everybody has that resource. So it's alternate. What if you don't know anyone that had bad credit? Or the thing is, some people don't like talking about it. It's embarrassing. So if that ends up being the case, it's leaning into resources like Yelp and Google to be able to see reviews. I'd say most experienced loan officers or realtors at some point through the grapevine should have that. That is a tool that most individuals should have. If the priority is qualifying your clients and being able to get them the best rate, that is a tool that most lenders and realtors should have in their back pocket to provide for their clients.
Should someone pay off debt that are in collections before applying for a mortgage or meeting with someone that can handle credit repair?
Sure. Probably the most frustrating thing I go through with my lenders and realtors, if I'm being honest, it is they're already referring out the client to get in touch with us to assist them with their credit. So ideally, it would be not giving them advice on what to do with their credit if you're already sending them over to us. Mm-hmm. And what I've seen, which is one of the more frustrating things that we deal with, is they tell their clients, pay off all of your collections, and then here, let me send you over to do credit repair. And the thing is, by them paying off all their collections, you're compromising the client, or the client is putting themselves in a compromised position in a variety of ways, which is one, they're just depleting their savings. Like, it's already expensive buying a house. The last thing you want to do is deplete your savings. Another one is a lot of these collections could be past the statute of limitation. They could be dormant, or they're only affecting the client. Time heals all wounds. So the collection that hurt you 70 points 5 years ago because it was, $5,000 collection, as years pass, it depletes and it stops hurting you more and more. And so if it's been dormant, where it might only be hurting you, say 18 points or 12 points or whatever it may be, by them actually cutting a check and paying it off to zero, at that point it re-stimulates the account and then puts the client in a situation where the credit score actually may drop by paying off a collection. They brought it back to life. So it is very much something that I've dealt with in the past. And we are charging the client the same, whether the account is zero balance or with a balance, because it's the same amount of work to get it accomplished.
How often should people check their credit? I know this is a big one in our industry where people are checking their credit every day on Credit Karma or other resources. What is your suggestion?
Right. I'm going back to my analogies, ladies. Do you jump on a scale every single day? I mean,
yes. Trying to see if it's going to be a different result, and it's not.
That's funny.
I think it can be, extremely, it's a good tool, right? So let's use Credit Karma. Let's use some free resources, right? Credit Karma. Some people may tell you it's bad. Some people may tell you it's good. We actually advise all of our clients to download Credit Karma when they start with us. What we tell them is, do not take the credit score personal, because it is not accurate. You get what you pay for, which for the most part is free, right? So we tell the clients, do not take it personal. Well, the reason we have them download Credit Karma is not because of the score. It's so that they can monitor their credit regarding changes. It's so that when we're removing accounts, if Credit Karma tells you an account came off, the account did in fact come off. If Credit Karma tells you an account got added, it did get added. So, we only have despite the monitoring we do, despite the, we're very well staffed to be able to make sure everything's falling in line. We do not have the capacity to check someone's credit every single day because we assume things will be relatively the same within, 5 days or 1 week. But things can happen. Between those 5 days and say 7 days, on day 6, a collection maybe could have hit. And we need to know if something got in the way of our goal in the middle of the transaction that can actually implode everything. So we do ask them, go ahead and monitor your credit, utilize the free resources. It is more likely to trigger an emotion from you as in your credit score dropped today 9 points or your credit score shot through the roof, 30 points as a result of open here though and take a look, find out why. So a lot of these simulators, they're not necessarily accurate. And if your score went up 4 points because your credit card balance changed by $70, it probably didn't. But it is their job that is how they make their money. It is all business. So if you see a drastic plummet, something crazy, we're talking about, I'd say anything over 40 points might be actually something genuinely alarming. Get on there and go take a look and find out what caused that 40-point hit. Like 3.7 points. The amount of text messages that I get on my phone, even from my friends and family, where it's like, "Hey, my credit score drops 6 points. What's going on? Can you guide me through it?" It's just a head shake every time. Like, you guys are killing me.
Yeah. So it's a good tool to get you the notifications quickly, but then it could be a little annoying.
It is.
So what are those increments? So they generally creep up 3 points, 2 points. What are the increments of increasing and dropping? But like you said, it can drop 40%. So that just means someone just bought a car or something with your credit.
Yeah, for sure. It could be very much so. Or you know what? The question you asked me earlier, this is actually extremely relevant. You asked me earlier, when people pay off their credit card and their score drops, what's the deal behind that? And I completely contradicted it and told you I completely advise my clients to do so. A lot of people would argue on that. Credit Karma actually is very likely to do that. It's very likely for you to pay off your credit card and your score might drop, leading into that frustration. Their algorithm just sometimes doesn't like it. It picks up on it and looks at it as a bad thing, and then it ends up dropping your credit score. So I'd say anything between 1 and say 15 points, it's probably worth ignoring. I think, again, it goes back to ego and making you emotional, making you upset or making you excited. But I don't think anything exciting actually happened or anything life-threatening actually happened. That's when you start seeing, say, 30 points, 40, 50, 70. That's when you end up being like, oh, this is a thing. It's alarming. What caused this? Which could be something good, right? Getting a car is a good thing. So you got, or it is a good thing, but your credit score dropped because now you added a new liability, you added something that switched up your history because now it's a day one account. So, that is a thing. And just the same, something that can impact your credit score was you were late and your credit score dropped 80 points. And, it's something that you need to get taken care of.
That's interesting because that just shows that's just the monthly or daily activity that you're doing, that you're seeing that fluctuation. How do you compare a credit score from Credit Karma, your bank, Experian? What's the difference from the different sources to check your credit?
Yeah, that's probably a question that everybody has that's super relevant, and everybody kind of breaks their head trying to figure it out. The most genuine, cleanest way to find out what your credit score is running your credit, taking that 5-point hit. And I think right now they just raised prices. I think it's like $120. I mean, it's a little spicy to be able to run credit. A lot of loan officers are not happy about it. The prices keep going. When I started in this industry, I want to say it was like $24.
Oh.
Yeah, it was crazy. It was super low. And over the years, throughout the course of my career, I've seen it, then $70 and $90. And now I believe we're at 120 plus. So it is a situation or that is the easiest, not the easiest.
The most accurate way.
Yeah, it was the most annoying and frustrating, expensive way, but that is the most accurate way of knowing your score.
Because that is a hard pull, and that's going to pull all the bureaus. It's not just Experian. And pulling the 3 bureaus and then coming up with that middle score is what your actual score is.
Yeah, it genuinely is. And I'd say the most, everything else, any of those free resources or tools, you get what you pay for, they're free. So
Yeah.
ultimately, it's their algorithm.
So take it like a grain of salt, more of a just keeping you up to date of where your credit is.
Where you might be, but it's not accurate. But it gives you an idea.
Yeah.
And I think you said you check yours through your bank.
Well, I check them through all of them. I do have Karma Credit, and I have Experian, and through my bank, I bank through Chase, and it has a section where it's called your credit journey, and it evaluates your credit, and it lists all your credit, and then it also has a button where you can switch, like, you know, if you're trying to improve your credit.
So that's usually through the banks. It's going to be one credit bureau. Is that correct, David? Or
Yes, it's one credit bureau, and it's usually wrong. So
I'm going to take this one off.
yeah, that's the biggest misunderstanding from buyers that I meet with, that they think they have a certain credit score because they checked it through their bank or through Credit Karma, and you know, I always prepare them like, hey, that's not your true credit score.
Yeah,
let's run it.
Well, because there's different credit scoring that you use, especially for a mortgage, to give you that credit score. Like, for example, and this is just off topic, when I went to go buy a car or a lease 2 years ago, and you know, personal knowledge,
standards are lower. Yeah.
No, there's a separate credit scoring for vehicles, and I did not know.
yeah, I was actually going to mention that, and you know, I didn't want to word salad you, but because it gets even more complicated, right?
Yeah.
We take a step further, which is, you know, that authorized user tool that I was mentioning. Say, Rosa, regarding your daughter, if she was 18, let's just say she's 19 and she has income, she wants to get her first home, you go ahead and add her on as an authorized user, the trade line you added her to is perfect. She would have a 700 plus credit score. She could proceed with the purchase of the transaction. Genuinely could.
It's pretty sweet.
Such minimal effort.
Yeah.
But send your daughter to the car dealership and she will get denied because car dealerships are looking for car history. So their algorithm is picking up something completely different, where your daughter now, you know, say she's a mega influencer and she's making crazy money and she can turn around and buy, you know, a point-something million-dollar home. In that same breath, she could go to a car dealership and try to get a $20,000 Toyota lease, and she will get denied because she has no car history. So their credit score will come back significantly lower, where they will reach out to you and ask you to co-sign because she has no car credibility.
That's interesting.
So the way the car industry runs credit is a complete different system from, you know, running credit through a bank or a mortgage lender.
Completely different.
Yeah. What is, just to give the consumers an idea of a credit repair program fees, I know it varies because everybody's scenario is completely different, but just to give us an idea, what is a typical program cost, like a range?
No, absolutely. You know, on the low end, and it's so relative to what's on the credit, but just to give you kind of an idea, right? So you can bring me someone that has a few random collections. They forgot to return their Time Warner box. You know, they were late here and there and have some random collections. They will probably end up with an invoice of, you know, $600-700. But in that same concept, you give me an individual that has a repossession, has an abundant amount of credit cards, has some student loans. I've been seeing so much student loan chaos lately on credit reports. So say a bunch of student loans, and then add on top of everything, they have no positive credit. Right? So not only do we have to remove everything, we now need to help them build and establish credit to get qualified. You know, they'll be wearing a good $3,000-4,000 tab around their neck, no problem. So
Okay.
It's that extreme. It's something where it can be relatively low and it can be extremely high, depending on how much, and you know, and everything in life is time or money. So an invoice that's say $400-500 that where the client can wait, say 5-6 months, you know, you can flip that and it would be an individual that's going to wear a $1,300 tab because of the fact that they're in escrow, they're going to end up living in a hotel, they signed off contingencies, and we have 11 days or everything's going to explode.
There's more time sensitivity. Mm-hmm.
Yeah. So it really depends on your timeline, and really, like you said,
How complicated the file is.
what do you recommend for someone that has zero credit? What is the best way to start to establish credit?
So outside of the authorized user tool that I mentioned, there's, that's a really cool tool for someone that has that privilege, but a lot of people don't, right? So the options there are, nobody likes secured cards, but they're not the end of the world. And if you don't have any other resource, then gun it with a secured card. Establish it the old-fashioned way. That's the old-fashioned way.
Yeah.
Alternatively, I could say retail, but lately retail has been reeled in, and actually, you can have a rocking credit score, have a crazy relationship with Chase and a crazy limit, and you will still get denied for your TJ Maxx card. It's just weird. It is no tote bag for you.
No tote bag. I love that.
Is it a myth that having I've heard people think, or I'm not sure, it might be true, that having phone service gives you some sort of credit?
That's a good one. That's so relevant right now. Like Netflix reporting, the cell phones reporting, rental reporting. So the products were released before the benefits to it have been released. So they did it backwards. And unfortunately, the algorithms haven't picked up on it. So maybe would someone argue with me that, yes, I've seen my credit score go up. They saw it go up on their Experian maybe, or on the credit card. I'd say probably the Experian, since they're offering that product right now. So they're not going to tell you your credit score dropped because you did what they told you to do to sell their product to you. They're not going to tell you that. So they're going to tell you, congratulations, your score is rising. But go run your credit with for the mortgage, go try to get a house. And they might even tell you to take every single one of those off, because those are liabilities now they wouldn't have taken in account, because they're not monitoring your Netflix bill, and they're not monitoring these random little trinket bills. In fact, they're not even monitoring your rent. They're not factoring that in, but now it's on your credit report. So when they take it, it goes through underwriting, it goes through DU. They're like, this person has so much liability on their credit and monthly payments that you never even had to report to begin with. That wouldn't be factored in if it didn't show up on your credit. So will they roll out something that actually may be relevant? I believe some of the bigger banks, the UWM, I know, just ended up releasing now a new product where they take those into account, and it actually helps. But I know very, very few banks that, as of right now, it is actually causing more of a problem than a solution.
But if you're not paying it, can that give you the bad credit?
Yeah. Well, now you're asking on the flip end, what if you don't pay it? So if you're paying it, I haven't seen anything positive come out of it. But I'll tell you one thing, if you don't pay it, it definitely will set you back, because at that point, you're now adding a negative account that you never even had to add to begin with. So you were not only not getting something positive, but now go ahead and throw in a negative into the mix. So hard pass on those.
Good question, yeah.
That's awesome. I really thoroughly have enjoyed this conversation.
Very educational.
Yes.
What's your biggest success story where you've helped someone where it changed their life?
Everybody has their own journey, and there's been several people that we've assisted through the years that, I've been very proud of. But I would say definitely individuals that have had medical emergencies. It was especially during the first couple of years. Right now, there's been shifts in the market with medical collections, but the amount of individuals say that there was that cancer patient, they were given a diagnostic, and that's happened to me many times throughout the course of the 14 years, where we've had clients that were given a timeline of life, and they were given a year, 6 months, whatever the diagnosis was. So similar to most people, you're not going to, that's not your priority to keep paying all of your debt and your credit cards and your 30% interest rate. So they end up just letting everything go. Fast forward, turns out they're alive and kicking, and then, now what? So it is really cool and satisfying to be able to give somebody a second chance, to where, credit aside, we always feel like everything's the end of the world when we're in it. For these people, it truly was the end of the world. And for them to have a second chance, it's cool to give them a second chance and be able to actually help them fix their credit. And now they, get to transition into buying their home or getting their car.
That's wonderful, yeah.
So that's very cool.
That
I know.
is
I've
wonderful.
experienced firsthand through my mortgage lender some success stories where you've helped our clients improve their credit score as short as 2 weeks. I've seen, so that's pretty amazing.
Yeah. It's been really cool collaborating. It's really easy also when you work with a loan officer that knows what they're doing. So we speak the same language, so we're able to communicate. Usually, inexperienced lenders or someone with a lot of ego will tell me what to do, and it's not a collaboration, it's a statement. It's like, I want you to do this, and then when things hit the fan, they're frustrated, and it's like, if it was more of an interaction where you tell me what your job is and what you need from me, and then I'll tell you how I can get you there.
Yeah. Well, thank you, and it's very, very educational and interesting. Is there anything we missed that you think we should have covered?
I have one.
Go, tell me.
What happens when the person passes away?
It's a good question. If they're married, it can be a little sticky. They can actually proceed to actually go over the husband or wife, the partner, especially if there was a co-sign situation. Yeah. If they were not married at that point, they passed away and the debt went along with them as long as there's no estate. I'll give you a good one that's super relevant right now is student loans. So, when in the student loan department, they were on freeze after COVID. And with the previous administration, there was forgiveness and there was like all these cool programs. All of a sudden last April, they ended up lifting the forbearances and everybody got hit with student loans at the exact same time. So everybody just got massacred with student loans. And what you ended up seeing is individuals that we were in the middle of transaction, we were trying to close, and now they get hit with a federal collection, and it completely compromised the transaction. I've never seen so many transactions compromised at the exact same time because now it's a collection from the government, and it got extremely sticky.
There was a time when they were able to forgive student loans. Is that only the people who followed certain steps to do that, or the people that got the forbearance lifted, they didn't apply for that forgiveness, or why?
Closed mouths don't get fed. And I know people that ask for forgiveness that they're chilling, they're perfectly fine, they make good money, their lives are doing just fine, and they applied for forgiveness and got all of their student loans waived. Isn't that the case? I think student loans, they're like the mob, there is no, so, I was mentioning that in California, there's a statute of limitation, right? So there's 4 years to collect and there's 7 years to report. So after 4 years, it doesn't matter if it was $1 million. They cannot do anything to you anymore as long as they didn't sue you within those 4 years. After 7 years, it comes off your credit organically. Student loans are one of the very few things that have no statute of limitation. So it is until the day that you die. And because most students didn't have credit, their parents co-signed for them. So if God forbid the student ended up passing away, the parent will inherit all of that debt. And vice versa. Say, let's just flip tables and say that the kid decided to help the parent because they wanted to go take a course or whatever. The kid has good credit. If the parent were to pass away, the kid inherits the debt. And it is not a temporary situation. The other person will carry the debt on if it's not taken care of. It's forever.
Wow. That's a downer.
Well, these are the things that we didn't know.
Yeah.
Thank you, David, so much. How can somebody contact you? We will share your contact information as well in our notes.
Absolutely. So our website is CredStart.com. We have, you can contact us on our office line. We're a large team that's there to assist you, even if it's just advice. So the phone number is 323-375-5777. And then follow us on Instagram. It's MyCredStart. So MyCredStart. Follow us on Instagram, and we're always posting videos and interactions and data that's relevant to that may not have been relevant 6 months ago.
Amazing. That's fantastic. Brilliant.
Thank you, David.
Thanks for listening. Let's talk SoCal real estate.
If this episode helped you, be sure to subscribe, follow, and share it. And tune in for new episodes wherever you listen to podcasts.
And if you're thinking of buying or selling in Southern California,
Click the link in the show notes for your free buyer's guide If you have any questions, we'd love to answer them all.
Isabel Machrone and Rosa Ortiz are licensed real estate agents with Keller Williams College Park. Each Keller Williams office is independently owned and operated.
The information shared in this podcast is for informational and entertainment purposes only and reflects our personal opinions and experiences. It should not be considered legal or financial advice.
We make no guarantees regarding accuracy, timelines, or results. We always recommend consulting with licensed professionals and doing your own research before making any real estate decisions.